I want to begin with e-commerce. Obviously not new, but it really has just exploded, and we've got to be going through a golden period for e-commerce. I love the statistic, like a year ago, Q2 last year, the statistic that in the US they did 4 years of online shopping penetration in less than 90 days. So consumer behaviors really have just changed permanently. And I think the other thing that's changed, that's really sort of corresponded or coincided, the timing has overlapped, is the new tools and channels that are available to merchants. So, and primarily through Shopify, which is a business I'm sure many of you have heard about. But so, if I'm a merchant, Shopify will say that within hours, I can be up and running. I can have an e-commerce website. It can, take orders and transact with customers, and totally connects into different sales channels. So, whether it's Facebook or Instagram shops, Amazon, obviously my own website. So it really just unlocks this potential for so many offline merchants to go online and start selling. I think we've been talking about this theme a lot internally, and Shopify comes up a lot. I think it's a really interesting case study in that Shopify is not in our portfolio today.
No.
Even though it is growing so rapidly, and it really is becoming, the tech back end for so many merchants. But actually, instead, we own a whole bunch of other businesses which are in related value chains, still tied to the e-commerce space, but they're in little pockets that have much higher barriers to entry.
And Shopify is actually driving their growth for them.
100%.
Right?
So,
give us a couple. Facebook.
So Facebook, So if you're a merchant, how do you acquire your customers?
Yeah.
To acquire a customer passively, it's basically through Facebook and Instagram. To acquire a customer through active product search, it's basically Google or Amazon. And that's it. So, to the extent Shopify drives more merchants to sell online and more consumers shop online, it's actually Facebook, Google or Alphabet and Amazon who are going to benefit disproportionately from the merchant spend on customer acquisition.
And then also on the payment side.
So payments. So if you transact on a Shopify e-commerce website, the payment is processed by a company called Stripe, which is private, or PayPal as well, another payment processor. I mean, these are great businesses, but even these businesses have to pay away a big share of their revenue to the payment networks owners, i.e. Visa
and MasterCard, right?
And MasterCard. So,
who make more money from transactions online than they ever did in the traditional brick and mortar world.
That's right.
And I guess that's the point. It's better for them too.
It's better for them. So their revenues will grow with this shift to online being driven by Shopify, as well as consumer changes in consumer behavior, except that their costs don't grow at the same rate. So costs are fixed, revenues grow, and you get these incredible profit margins. So that's e-commerce, right? So that's a little bit of a case study in this booming sector, which is just inflected post-pandemic. And we've tried to isolate the best businesses to own in that space.
I'd add to that before we leave, because you kicked off by saying that we brought forward 4 years of e-commerce and online spending. And naturally, I started to think, well, we sort of finished there. What was interesting to me the other day, though, was to learn that online commerce is not just taking away from traditional retail spending in brick and mortar stores.
Right.
But there's a bigger opportunity there, right? Like there used to, on traditional stores, you used to have to pay rent. Now you pay away to Shopify or other companies to facilitate your space on the internet to really give you that e-commerce platform. So there's a bigger pie to play for than just the trillions of dollars of retail spending that's already out there at the moment.
Yeah, 100%. So and even just in terms of the retail spend, which is online today, like it's still less than 20%
Yeah.
in the US, right? So there's still a very, very long way to go. So that's e-commerce. So let's talk about something else. Why don't we talk about, still in this theme that, our lives and business models are changing and shifting online. Let's talk about the creator economy, because, this is something which is very topical. It's being talked about a lot by the likes of Zuckerberg and others. So tell us about this creator economy boom.
Yeah.
What does it even mean, the creator economy?
I originally thought the creator economy, we were talking about music artists that publish big albums and do millions and millions of record sales. And I guess you would say that is part of the creator economy, but not all of it. And, creators these days go anywhere from writers and authors who are looking to publish their work on Substack, a platform for them, but also some of the smaller artists that can publish their works, or we can listen to their music on Spotify, all the way down to influencers on Instagram and Facebook. And really, the creator economy gives anybody that has a passion or a hobby, something to say or something for us to listen to, a forum to be seen and to be heard, maybe much like ourselves right now. A forum to be seen or be heard, and more importantly, to be able to monetize that content that they create
through their fans, right? So it's building up a fan base and then engaging with them and creating digital experiences, and then being able to monetize those fans.
And the way they monetize it, or what's most important here, the critical linchpin, is the platform in which they conduct that engagement with their fans. So if it's music, it's Spotify. We said before, if it's written content, might be Substack. If it's promoting products, then it's going to be Facebook or Instagram. And this is a massive, massive economy that's emerging that we wouldn't have even been talking about a few years ago.
That's right. And these platforms, your Spotifys, your Instagrams, they are rapidly rolling out tools to make it super easy for creators to monetize in various ways. So it could just be a simple monthly subscription. It could be bespoke one-off, digital events that you can charge for. It could be like tipping. Facebook, you can tip your favorite influencers now. So these are brand new revenue streams, which are in a sense unrelated to the core advertising business, because in the case of Facebook, they can just take a percentage share of these revenue streams in the future, and they're potentially enormous. I mean, Zuckerberg said the other day, do quick rough numbers on Facebook. There's about 200 million small and medium-sized businesses on the platform. Only 10 million out of that 200 million actually spend any money today. But then in addition, there's another roughly 200 million individual creators, right? So, which, are totally unpenetrated with respect to the ability for them to monetize their fans, or it's in the very, very early innings. So this is a whole new kind of economy, and it's just getting going, and we think it's really interesting. And businesses like, Facebook, Spotify, and over in China, it's Tencent are the ones who are best positioned to take advantage of this boom.
Do you want to change gears again and talk about another big theme that we've been looking at?
Yeah, what do we want to do next?
I think we want to talk about gaming.
Gaming,
We want to talk about 3D content, 3D publishing.
So gaming's really important. It's when you actually look at data around, the amount of time that consumers spend doing whatever, it's always gaming and entertainment, which are the number one. So, you might be watching shows on Netflix, but it's incredible the amount of time that people spend either mobile gaming or more serious PC gaming. It's interesting, Roblox, which is not a portfolio name, but Roblox is a new recent IPO, which is all about, it's targeted for younger kids, under the age of 13, who are able to, actually create games and create 3D worlds online and can actually interact with their friends and whatnot. And, you know, it's extraordinary that they've got over 30 million kids who spend, you know, 3 hours per day, every day on average on this thing. So it is a really big deal.
They make any money out of those kids on that platform?
They make some, perhaps not as much as their valuation would suggest that they should, but that's a separate point. So gaming's really important. We have exposure to this thing in a number of ways, not only through names like Microsoft, which obviously owns Xbox, Tencent, which is the world's largest gaming publisher, but also through a new position called Unity Software. And so for those who have already received and read our quarterly letter, you'll see there's a case study in there on Unity Software. And so I won't repeat that now, but very quickly, Unity owns one of two gaming engines basically on planet Earth. And so all video games are made either with Unity or with a gaming engine called Unreal, which is owned by Epic Games. Quick aside, Epic Games also owns Fortnite. So anyone with kids or grandkids who you haven't seen for the last 2 years, that's thanks to Epic Games. By the way, Tencent also owns like 40% of Epic Games. So we're actually exposed there as well.
Yeah.
Anyway, so you have these two gaming engines. It's a total duopoly. And with respect to Unity, they actually skew disproportionately to mobile games. They dominate mobile games overwhelmingly, as well as dominating virtual reality and augmented reality, which are really sort of, we would describe it as that is where future content is going disproportionately.
It's like the next frontier, not only of gaming, but of a lot of the online experiences that we'll be having.
Totally. And so one of the areas that we think is really interesting for our Unity thesis is that it's not just about, you know, here's the mission critical engine that is required to produce all future games and can take a share in those future games economics.
Which is pretty good by itself.
Which that would be totally
That's
fine
excellent.
just on its own. But one of the big opportunities, and it's a longer term opportunity. So this is a long duration investment. This isn't like you know, let's see what happens next month type of thing. It's all about, you know, the probability that Unity becomes the the 3D content creator for the masses is very, very high. In fact, they're probably the only business that can do it. And it's not unlike how Adobe's Creative Cloud just totally dominates 2D creation. So everybody uses Photoshop now and all the other tools. And whether you're a professional or whether you're just, you know, touching up your profile picture on Instagram or whatever, everyone uses Photoshop. So we think that there's a big chance that what Adobe was in the 2D world, Unity will become kind of the Adobe of the 3D world, which is really the future. So long story short, we think it's a wonderful business, has effectively no competition and is drastically under monetizing today relative to where we think it will get to in the future.
And like the other themes that we've talked about, these aren't things that are going to happen overnight. Right. These are transformations and trends in new markets that are going to develop over a decade or more.
Exactly.
Another one that I wanted to talk about in the same vein is enterprise technology.
Yeah, so let's jump. So we've talked to consumer, now let's jump to the enterprise side of things.
And look, the biggest theme I think running through enterprise technology today is the cloud. And you know, we have quite a few businesses in the portfolio, and we've looked at even more businesses that have cloud services and offer cloud services to large enterprise customers. Now, the biggest ones, of course, at least in the Western world, are Microsoft and Amazon. Microsoft and Amazon really have a lock on the public cloud. Amazon through Amazon Web Services and Microsoft through their Azure business. Microsoft actually have another growth engine to their cloud business, which we might come back to. But it's amazing to think that Amazon Web Services is a $50 billion business today. and it's still growing at 70% per annum.
Yeah.
Because more and more enterprises are signing large agreements to use their cloud infrastructure. So all of the hardware, the servers, the networking, storage. And the same is true for Microsoft Azure, which is a business that's almost that size, and it's growing at 50% per annum. And it really has a lock on or is uniquely positioned to offer the platform software for big companies to develop their applications, to run them, and to extend them.
And so I guess the question is, you know, in the minds of investors is, you know, are these very high growth rates about to totally run out of steam? You know, has this market already been penetrated and it's about to mature? Obviously, we think no, right?
No, absolutely not. The total spend on infrastructure as a service, which is what we refer to as the cloud, and platform software as a service, which is that next component of public cloud computing, is just over $130 billion today in the United States, whereas the entire market for platform and infrastructure services that was once done in corporate data centers, I mean, that's a $1 trillion plus market. So,
right.
So really,
and that's today, right?
That's today. The cloud's only just got going.
Growing probably 3x over the next 10 years.
Yeah, and look, that story is even more compelling and more impressive in China.
Right.
And that's where Alibaba, I knew
dominated.
Come back to Alibaba.
Yeah.
And Alibaba's cloud business owns 40% of that market already. But it's you know, as much as cloud computing is only getting going for enterprises in the Western world, I mean, we're probably a few years behind that in China. There's only 3% of GDP is being spent on IT today in that market. The number's 10% in the US. So there's a long way to go. There's long growth runways. And I think more importantly, there's only a few really big businesses around the world, like Amazon, Microsoft, and Alibaba, that are in position to be able to capture all of this growth. And it's trillions of dollars of growth.
Yeah. So, I mean, as you know, right, we say we want to own the long-term winners in attractive markets. The nice thing about this space is we know the market's attractive, it's enormous and growing rapidly and has very high barriers to entry. And the other really nice thing is we already know who the long-term winners will be, right? Because that's sometimes unclear. But in the case of cloud, the winners have already been defined today, and now they are just set up to capture the growth for, you know, the next decade and beyond. So why don't we switch gears again? Because obviously we've talked a lot about some tech names, but we are, believe it or not, we are not a tech fund. We don't identify exclusively as being experts only in the technology space. Of course, you know, when your mandate is to own the long-term winners in attractive markets, you're always going to gravitate towards some of the winners in the tech space because a lot of these markets are just so damn attractive. But we also own some other long-term winners in very attractive markets, and one is in the alternative asset managers.
That's right.
So talk a bit about that space.
Yeah, so alternative, there's a massive transformation that is going on in the asset management industry today. And it is a gravitation away from traditional investments, public market investments like public market equities or bonds. It used to be commonplace for big institutions around the world to allocate their portfolio 40% to stocks and 60% to bonds, and that's how they get the returns that they needed over time. That's changing. And
because you don't get much out of bonds, right?
You don't get a lot out of bonds. So that one big part of that allocation, that 60% bucket, is looking for a new home.
Right.
That new home is in alternative, non-traditional assets and often in private markets. And so we're talking about things like private equity. We're talking about private credit and direct lending. We're also talking about real estate is another one. Power assets, infrastructure assets. So there's a lot of other asset classes and sub-asset classes that are benefiting from this transition. And there are a few large alternative asset managers around the world that have effectively locked up this marketplace and are going to be the winners over the next decade.
So the nice thing, and of course we're talking about, you'll see in our portfolio, like Blackstone, KKR, Carlyle Group, are probably the three most important names in our portfolio that relate to this theme. The really nice thing about these businesses, if you think about, the microeconomics of these businesses, is so you've identified the shift in flows, so assets flowing out of just sort of vanilla fixed income into alternative asset managers. Naturally, the biggest three platforms in the world capture a disproportionate share of those flows. So they're growing with flows. We've talked at length about the low interest rate environment that we find ourselves in the past. Of course, that inflates asset prices. So you've got growth from flows, growth from asset prices, and of course, those two things drive the revenue lines of these businesses. But of course, their costs don't grow. These businesses are a little bit like Visa and MasterCard that we described before. Incredible growth on the top line, but the cost base is relatively fixed, right?
That's right. And we saw that in the latest set of results. So all three of those businesses published excellent results for the full year of 2020. In fact, together, they now control over $1 trillion of assets, and they had $170 billion of inflows. But of course, that delivers more and more revenue without additional costs. And we saw their profit margins and their earnings start to expand at an even quicker rate, which is really impressive, but completely expected for the sort of businesses that they are.
Yeah. So it's in a way, even though these are not tech names, the economics of these businesses actually behave in a similar way to some of these tech names who can grow their top line without having to spend a disproportionate share of capital. And so you get sort of this wonderful top line growth, low capital intensity across relatively fixed cost base, and it just drives this wonderful earnings profile, which again, in a low interest rate environment is enormously valuable. And so that's what we're shooting for there.
And it should happen for a long, long time to come. There's, still only, I think, 5% of the value of public equities invested in private equity investments today.
Wow.
So that shift still has a long way to run, just like some of the other transformations that we've talked about already.
Perfect. All right. Well, I hope that's a good summary of some of the themes that are in our portfolio and some of the names that we own today.